Okay, now I have to define something. Acquisition debt is a term. It's actually an IRS term. It's part of the government that says this. It is the loan that you put on the property to acquire it or improve a primary or secondary home. Okay, so now let's break this down. What's a primary home? The one you live in. What's a secondary home? Could be a cabin, could be a lake home, could be a condo. The difference is a place that you stay for a couple weeks or more a year. It's a secondary home. Okay, now, I'm telling you can deduct the loan, the interest on the loan, on your primary and secondary homes combined, but the total loans cannot exceed $1 million. Got this? It's not $1 million per property, it's $1 million total. So watch this. Let's say that I'm a person who has my primary home here in the Twin Cities. I have a cabin on the lake up north, and I have a condo in Scottsdale, Arizona. I have 3 properties, got it? I can deduct interest on how many of them? 2. Which 2? My primary, which is the one I live here in the Twin Cities, and then which secondary? Whichever one I choose that probably has the biggest loan, as long as the loans don't equal more than $1 million. Did you get that? All right, so now I want to give you a really simplistic example here, and don't get hung up on the numbers when I do this. It's just to show you the example. Watch. Let's say we go out and we purchase a home, and the home that we purchase is going to be a starter home. It's going to be for $200,000. The way we're going to buy this home is we're going to put $50,000 down as cash down payment. The balance is going to be a $150,000 loan, and to make it simple for my examples, I'm going to say the interest is 10%, which I know is high, but it's easy to show you the math. Which means, therefore, my interest would be about $15,000 a year. Okay, here's the point. This is what I get to deduct from my income over there, thus reducing my taxable income, thus reducing my tax. Because this is the loan that I put on the property to acquire. And I'm telling you, this loan of $150,000 can be up to how big? $1 million if this was my only home. If I have a cabin up north with a $200,000 loan, then this loan could only be up to $800,000. You get this? Okay, that's pretty straightforward. But now watch this. Time goes on. The value of the real estate goes up to $400,000 over the years. The balance of my loan for $150,000 now drops down to about $40,000. When it drops down to $40,000, I'm still paying my 10%, which would be $4,000 of interest. But now I have equity or value in my home of $360,000. Okay, now here's what I'm going to do. I'm going to borrow against my equity $200,000. When I borrow against my equity $200,000, I'm going to pay interest on that loan of 10%, which would equal $20,000 of interest. So now here's my question to you as a group. If I own a home and I borrow $200,000 against it, pay $20,000 of interest on that second loan, can I now take that $20,000 deducted from my job or career over here? I'm now going to teach you how you should answer every tax question you're ever asked. You should say this: I don't know, it depends. The reason you should say I don't know, it depends is because you cannot answer this question unless you ask me a question. The question you would have to ask me is, what did I use the $200,000 for? Because I said you can only deduct interest up to $1 million if the loan is used to acquire or improve a primary or secondary residence. So here's the question. Did I use that $200,000 to buy this house? No. So there you're going to say, well, what did I use the money for? Well, what if I told you I did this? I borrowed the $200,000 to finish the lower level, to take the 2-car garage, make it a 4-car garage, and to add a 4-season porch to the back of the house. And I spent all $200,000 on those improvements. If I did that, did I just acquire a nicer house? Still the same house, but is it now nicer? And as long as the loans are still under $1 million combined, then yes, I could deduct the $20,000 from my job or career over there. Did everybody get that? The reason is I used this money for that house. Then it's considered to be acquisition debt. Now, when I say I use the money for that house, I had to use it for one of these 3 reasons, which is the next thing in your notes. I had to use it for capital improvements, which is anything that increases the value of the property, extends the useful life, or changes the property use. Real simple example. If I own a house and I have equity in my house and decide to borrow $10,000 against the equity to put on a new roof, could I deduct the interest on that new roof loan? Yeah, why? What does the new roof do? Extends the useful life. Okay, how about this? I decided to put a $50,000 in-ground swimming pool in my backyard. I'm going to borrow the money against my equity to do that. Could I deduct the interest on that loan for the swimming pool? Well, here's what you ask yourself. Go through the test. Does the swimming pool in the state of Minnesota increase the value of the property?
No.
Not necessarily. Does the swimming pool extend the useful life of the property?
No.
Wait a minute, if I have a fire, don't I have water readily available? No. Does the swimming pool change the backyard's use? Yes, so you pick it up there. And my point of this is it's any one of the three, not all three. Make sense? All right, now back to my example here. I now live in my $400,000 house, and I'm going to borrow $200,000 against my equity, but this time I'm not going to borrow for any of these three reasons. This time I'm going to borrow the $200,000 because I think it's about time that I celebrate my life, so I'm going to borrow the $200,000 to go out and have a wild party. First question, will it be a good party?
Yeah. Yes.
The answer is, it depends. What does it depend on? Whether I invite the Vikings, because I heard they have good parties. Okay, if I borrow the $200,000 to have a party game, can I now deduct the interest? Yes or no?
Yes. It would extend your useful life.
The answer is no. This has to extend the property's useful life.